last job, I was the CEO of S&P Dow Jones Indices, where we own the S&P 500 and about 1 million indices that we calculated every night. In the investment business, you have a lot of complex products, a lot of hidden fees. Why are people making this recommendation to me? What's in it for them? Are you pushing the product that has the highest fees, or are you pushing the product that's actually the best for that customer? Is their incentive misaligned with the customers? If somebody's making them a recommendation, why? Ask why. Are they really looking out for your best interests?
Alex, it's great for you to be here. Thank you ever so much for taking time out of your schedule to chat with me. After our chat last week, I thought it'd be great to have some questions that I think some of my customers are asking. First of all, can you just do a quick introduction of yourself?
Sure. I'm retired now, but my last job, I was the CEO of S&P Dow Jones Indices, where we own the S&P 500, the Dow Industrial Average, and about 1 million indices that we calculated every night. Across the globe for ETFs, index funds, tracker funds, insurance products, benchmarking. Prior to that, I was an index portfolio manager and trader, and earlier in my career, I started out in the options industry as a buy-side options trader and portfolio manager. So I've seen indices and the wealth industry, the broader wealth industry, from many different perspectives.
Now, one of the things that you mentioned to me last time was that you wanted to see more transparency in the financial industry, in the investment space. Where do you see the biggest need for that is?
I think just transparency is always good for anything, right? Number one, if you're hiding things, it's never good. And when you're dealing with people's wealth, I think it's always important to understand both whether it's the interests of the providers of the services, the fees, expenses, performance, and the amount of risk you're taking in investments. That all falls into this broader idea that products should be more transparent. Unfortunately, in the investment business, you have a lot of complex products, a lot of hidden fees. And at the end of the day, I think, investors have to make their own choices, or through their advisor make their own choices. But you can't make an informed choice if you don't have all the information. And so that's why the concept of transparency really is important, whether it's an index and how the index works, or fee structures, or incentives, which is a big issue where you wonder, why are people making this recommendation to me? What's in it for them?
Yeah. And you mentioned performance. That long ago, a lot of people didn't show the performance of the funds. And actually, I'm seeing that now on when I'm chatting with people in their pensions, and actually they've got no way to see how that's performed over the last year. That is a thing and allowed. Because you, like you say, you want to know how you're doing.
Yeah, and it's hard though. So you have to think of performance at several levels. Typically, you can find performance of a particular fund. Hopefully, that should be available, whether it's net of fees or gross of fees. Again, it's something, right? It gives you some benchmark.
We have far fewer investors in general than the US. We are savers. Certainly, the government is trying to do a push at the moment to try and get more people investing, because it's all savers, which is mostly losing to inflation. What would you say is the first thing that people should think about when they're starting to invest?
I think people underinvest typically. And as you said, cash, people historically, cash was a safe asset, right? It's in the bank. And so you knew it was there. The problem, as you pointed out, is inflation. Inflation eats at returns. I think 10-year gilts are something like 10.7% right now. You lose, I don't know the exact rate of inflation in the UK. You could easily be losing 2-3% of that right off the bat to inflation. So I think playing the long game also helps get through those. Is the market overvalued or undervalued today? Is it the timing aspects of it, which are, nobody's perfect, right? Anybody that sits here and tells you that they're the perfect market timer, they're not. The studies show that's the case. So I think being more aggressive in terms of making sure you invest for the long term, having enough in equities and balancing it out, diversification is important. But thinking long term, especially if you're at that stage of your life where you're looking at kind of wealth accumulation, whether it's for retirement, whether it's for paying education bills or having money put aside for healthcare when you're much older, or buying a second home.
You mentioned earlier around the kind of transparency on funds and what they're in. I read earlier today a damning piece on St. James Place. So St. James Space, if you don't know who they are, they're an advisory firm. They are not independent. Turns out that one of their largest funds is about 14% in St. James Place itself. St. James Place stock has nosedived this year, which has meant that one of their larger funds is also nosedived because it's heavily in themselves. Do you have any views in general financial advice space?
I think finding a good advisor is important, right? Given that most people don't have the experience that the advisor has, assuming the advisor actually knows what they're talking about. There's a lot of bad advice out there. There's a lot of free advice out there, right? Anything that's what I would call a cookie cutter approach, right? One size fits all, typically doesn't work very well, right? It's interesting, you can learn from it, but everybody's situation is different, right? And so I think from the customer side, an advisor that listens and understands what the customer, the investor is trying to achieve becomes very important. Understanding on the other side, understanding their conflicts and why they're making the recommendations they're making. To the extent that they're selling funds that they have a conflict, it sounds like a natural conflict, right? I don't know. I think St. James outsources some of the money management itself, I believe, right? And are those same money managers that they're recommending to their clients rebating fees to St. James Place, right? Are you pushing the product that has the highest fees, or are you pushing the product that's actually the best for that customer? So I think you have to be very careful. I think a good advisor is critical to that. I have a preference for advisors that aren't selling their own products. Now, in many markets, that's not always the case. It's not always available. At the very least, there should be very good disclosure that if they're pushing a product that has high fees, how much are they getting out of it? Is their incentive misaligned with the customers? And I think those are important issues that you need to grapple with an advisor. One of the reasons ETFs have grown so much in the US was that it moved a lot of investors out of house funds or funds with high fees offered by the wirehouses, and it gave people more transparent. Now, there are some rebates even in ETFs that people don't realize, but you're starting with a much smaller cost product. So that's better. Again, it's never perfect. There's always going to be some fees. But understanding, again, the advisor, making sure they're providing the type of service you want goes beyond just financial advice. Are they providing estate planning services? Are they providing tax advice? Do they have the capabilities that you need? And so everybody's situation is different, which is why when you have to understand what services they're providing and are they what you need.
One of the things that I've come to learn after I did my financial advice course was in the UK, we actually have a very clear distinction on guidance versus advice. So advice is all around recommending a specific regulated product, whereas guidance is all of that other bits and pieces around it, where you're not necessarily recommending a product, you're just trying to increase financial literacy, ultimately. You've had many years in the industry. What would you say is what one thing would surprise most retailers about the investment industry that they don't already know?
I think the conflicts of interest issue is something people don't always appreciate. You don't want to be cynical about it, but if somebody's making a recommendation, why? Ask them why. If you go out and do it on your own, that's different. Then you've got only yourself to blame. But you're relying on an advisor. Hopefully they're acting in a fiduciary capacity. Again, that's a legal concept that's different in every jurisdiction. But are they really looking out for your best interests? And that's why the fee structure makes a difference. The types of products they offer makes a difference. Doesn't mean that people shouldn't invest in private markets and things like that. They're appropriate for the right investor, but don't push one product just because your compensation as the advisor is tied to that. That to me is a problem. The other thing is that I think sometimes advisors look too much to the short term, right? And I use the example of you bringing in a decorator to your house, right? No decorator is going to come to your house and say, this is perfect. You don't need to make any changes, right? And so some advisors are always going to sit there and say, I need to justify my existence. And so I'm always going to be making some changes. And sometimes the best advice is not to do anything. Playing the long game, I think, is important. You see the value of wealth accumulation coming from compounding, low-cost products. That's a huge advantage, right? I know it's a bad analogy to use, but you want to be the house in a casino. In the game of blackjack, everybody else goes bust first, and they're the last person standing. You want to be the last person standing as an investor, right? And so eliminate as many of the frictions and play for the long term, because Really, it's all about maximizing wealth for a given level of risk. If that comes from a simple product structure, why not? Don't overcomplicate things. But complication comes with advice sometimes because people have to justify what they're doing and trying to look smart. And trust me, there's a lot of advisors that don't understand the products that they're offering. There's some very good advisors out there, certainly. But understanding and playing that long game sometimes conflicts with an advisor. Now, if you're getting paid an hourly fee or an annual retainer fee and it's got nothing to do with asset levels or it's tied to asset levels but not transactions, that's okay. You understand where their incentives are coming from.
What are your views on active versus passive?
UK is famous for high profile star portfolio managers, and they oftentimes live off the laurels of what they did 10 years ago or 5 years ago. They go through cycles, right? The studies show that over time, active managers tend not to outperform the relevant benchmark. Doesn't mean that they can't in any one period. Doesn't mean that there aren't good active managers out there. But to do it consistently and to do it ahead of time, meaning can you know today who's going to outperform tomorrow over the next 5 years? You can't. The studies show that you can't. So you're getting the exposure and the value comes from that exposure. And again, in many cases, you want a single fund that gives you exposure to equities across the globe. They're available. Many people know Warren Buffett, right? The Oracle of Omaha, as they say, who made his money on buying companies, not investing in stocks, as he'll tell you. But what did he say for his own estate? Where should the money go for his family? Into an index fund. Why? Because he said what he did is the exception, not the rule. He had access to information. He had access to buying actual companies through their stocks. And very rarely does he sell them, right? He typically holds them because he's looking at the business, not the stock. But what he recommends to most people is buy an index fund, right? Because you're not going to have access to that same amount of information. And if you think you do, you're probably misguided. For your clients that remember the LIBOR scandal, which started in the UK, LIBOR was an index that was manipulated to suit the banks that were contributing prices. So the everyday LIBOR prices came from individual banks. It wasn't a traded price. So it was a dealer that said, hey, this is what I think the current offering rate is. And if it's a little bit higher, a little bit lower, that affected their P&L of their trading book. That's a conflict. Regulators got after that, unfortunately, a little bit late. But that's where I go back to understanding conflicts and people's vested interests is very important.
Okay, and then on like US markets, do you have any views yourself or opinions on the current valuations?
I don't look at that, honestly. And I think I tend to take a very long-term view. I think that's important. I think things like dollar cost averaging make a lot of sense. If you think you're going to pick the bottom and sell at the top, it's just as much luck as it is skill. There's a lot of smart people trying to do that. Inevitably, they're not always right. So I think you need to just look through that. Now, does that mean you liquidate all your bonds and go into equities today? But if you've built up your portfolio over time and you're looking out 5-10 years down the road, you shouldn't have to worry day to day. If you're investing every year, for example, either ISA contribution or just normal investments, doing it over time, you're going to pick, sometimes you're going to go in at the top, sometimes you're going to go in at the bottom. But the point is start saving, save early, because the value of that compounding, even a little bit of difference, makes such a huge difference. And just maybe I can just give you one example, just why it's important to start investing early versus later, and why things like fees make a difference, and not worrying so much about the timing of the market, because as I said, you could be just as right as you are wrong. But if you take two investors, one that starts saving at age 21 and another one that starts saving 10 years later at 31, and they save every year, they put 10,000 pounds into an account and they both get to 65. They both contributed different amounts. If you start at 21, you've invested altogether about 450,000 pounds. At a 5% rate of return, that's worth almost 1.6 million pounds. If that same investment earned a 0.5% less, now 0.5% could be the fees in these funds, you'd be at about 1.4 million pounds. So 100,000 pounds over your lifetime just because of a 0.5%. So it makes a difference, right? And that to me is why ETFs or index fund trackers make sense, right? They're just a little bit lower. Now, take the other example. You start not at 21, but you start at 31, right? At the end of 65, if you invested at earned 5%, you'd have 900,000 pounds. So again, 10 years difference, it's a difference of 600,000 pounds. You've invested 100,000 more, of course, but at the end you have 600,000. So it's a huge difference, right? And so starting early, compounding, low costs, at the end of the day, it's what you have left when you're 65. Hopefully you're around to enjoy it. It's not going to your kids, but that's the game, right? That's the game of wealth, growing wealth and wealth accumulation, is to do that. And so, as I said, those are the important factors that I think people don't appreciate. Say, I'll start next year. Start small. Not everybody can put aside 10,000 pounds a year. But if you can, it just shows you the difference. Start right away. Start right out of school. You can do it in a tax-deferred account, whether it's company-sponsored or an ISA or something like that. You're growing tax-free. It's a huge advantage, and you'll enjoy it down the road.
I was chatting to my nephew at the weekend. He's 21, so he's on a year out at university at the moment, working. And he was asking around whether or not he should opt into his company pension. Like,
yes,
especially
if they match, right? Do they
exactly
match some of it?
And they
Absolutely.
match quite a lot. And I'm like, yes, please do. You have to. If you're asking that question, you won't even realize the money isn't there. It goes into your pension tax-free. You've got decades to go.
And you're doing it every paycheck, right?
Yeah.
And so, again, to your point of valuation, it's irrelevant because you're going to dollar cost average or pound cost average the UK. But that's so important to start. That's what I said, starting young. In the US, they just started they're calling them these Trump accounts, because compounding at a tax-free rate that's the game.
It's that eighth wonder of the world, huh? Without talking specifics, numbers, do you practice what you preach? Is your portfolio mostly index funds?
Yes, I would say it's, other than some stocks of companies that I worked for that I still hold, which again is another issue because you get concentrated positions aren't always necessarily good, but sometimes you have tax issues if selling. It's all issues that I'm sure you know about. So I have some low cost stock that I can't afford to sell. Well, if I do, I won't earn back the return, right?
It's interesting. There's loads of people that have got portfolios that they don't want to touch or sell because of the tax issues.
Yeah.
And I think was it you that mentioned that people have bought old funds in the past that aren't even performing well now?
Yeah.
Right? Like old managed funds that are doing nothing for them, but they just don't want to sell it due to the tax.
You're locked in, absolutely, and that's a problem. Now, I think, again, managing things from a tax standpoint is important. So I sell some of my company stock every year, but I sell it for a risk purpose, not for tax purposes, because I'm not going to earn back without paying taxes. I know that. So I sell it out over time, and some of it will go to the U.S. If it goes through your estate, you get a step up in basis. So maybe my kids will enjoy it down the road. But other than that, everything else I own is ETFs. Now, I own a bunch of them. I own some core positions. I have some that I'll trade in and out of, some country funds, some very sector funds and things like that. But again, I've built a portfolio around kind of core investments that I don't touch, just let it go. And then on the margin, right now, I like Latin America. And so I have some funds that are targeting to that. But I would say it's a core satellite type approach.
Any new person just starting to invest over here in the UK, the general guidance seemed to be around kind of low cost index funds, diversified, don't go too wild to begin with. Over time, learn what you're wanting to put it into.
Yes, absolutely. And read, because there's so much information that was not available even 10 years ago. And so that's good.
One of the things that I do come across is people thinking that they don't have the time to do it. So you can be a super lazy investor at the same time, right? Where you are just having a couple of things that it's just doing a direct debit to buy every month, and it's just going in and you can set and forget to a degree.
You know what? For a retirement plan, that's perfect, right? Like you said, it comes out of your paycheck. You don't realize it. You live to the bottom line, not the top line.
Yeah.
That's the best thing that can happen. And the companies match it. Why not? Right?
Yeah, exactly that. Thank you ever so much, Alex. This has been wonderful. Thank you for your time and answering these questions.
My pleasure.